All right, welcome everyone. Welcome everyone to Project Options Cashflow Day 11. Yeah, all right. Okay, we are in day 11 of the entire challenge today, and we're going to cover the topic of sell call spreads in our session today. Okay, now if you are already joining us on the session, do leave a comment and say hi. All right, so I know you'll join us on the session. All right, hi Irene. All right, good to have you here. Okay, hi Ploy. Oh, hi Uncle Tan. Hi James. Hey, great. Hi David. Hi Maureen. Hi Kai. All right, hi YC. Yeah, hi Mary. Okay, now so we'll get the session started in a short while. Okay, just some standard. Welcome, Juanita. All right, welcome. All right, today is going to be an interesting topic for both I'm Possible graduates as well as newcomers and friends of your friends who are joining us for this session today. Yeah. Okay. Now, if you have not done so, all right, you see a QR code at the bottom of your screen. All right, please make sure you scan the QR codes to join our Telegram channel for I'm Possible investors or cash flow with turns. Now, so today our lingo for today is actually the CBOE Volatility Index, right? Or commonly known as the VIX. Okay, so the VIX is basically known as what we call a fear gauge or a fear index. Okay, it's not an absolute index where it can tell you the turning point of the markets, but it's definitely capable of telling you what the sentiment of the market actually is. That means, are people complacent right now about their risk? Or are they, actually very fearful about the risk that's going on in markets now? Okay, so that's our lingo for today. Yeah, as you may all know as well, markets are down pre-markets right now. So are we going to see the turnaround or the typical behavior of the day after Fed? Okay, as I've mentioned in yesterday's video, if you join us, the day after Fed is always where we get a reversal of the previous day's movements. So we got a sell-off towards the close of the market yesterday, right? So if we do get a reversal move, that means we should see the markets move higher today, right? Opposing the actions that happened last night. Okay, but that leaves to be seen because right now everything seems to point towards a negative market open in a couple of hours' time. Yeah. Now, so if you have not helped us done so yet so far, okay, could you just click on the share buttons? Right, so we can have the videos going out to as many people as possible, right? And we get to have more interactions actually, right? Get more interactions going on in today's session as well as the subsequent session to come. All right, so we have gone into the option selling component of the entire challenge, right? So this is where I'm going into my mental over here where this is what I'm good at doing. So I'm going to cover a lot of different aspects and deliver as much as possible for those of you who are staying tuned over here. Yeah. Okay. All right. So do remember, click on the like buttons as well as the share buttons over here on your screen. Yeah. Okay. Now, so let me get to my PowerPoint slides and we'll start the session off. All right, everyone, welcome to I'm Possible Project Options Cashflow. All right, where we'll be doing this for the entire month of June. Today happens to be day 11 of the challenge. Now, so just a standard disclaimer, investing presents a risk of a loss. So everything that I'm going to discuss in today's session is purely for educational purposes. So if you're going to take on any suggestions or anything that's being mentioned in today's session, do understand that you have to value your own risk and evaluate it before doing so. Okay. Now, so today our strategy and focus is really on the cash flow strategy series. And today, day 11, we're going to cover the sell call spreads. Okay, commonly known as what we call the insured call option seller. Yeah, yesterday we talked about selling call options, and we said one of the biggest problem was really the unlimited loss that comes with it. Okay, so today we delve into another topic of how you can sell call options. And that comes with an insurance tag to it. Okay, this is why we put it in brackets, the insured call seller. Yeah. Now, so same thing that we'll go through. We'll cover the basics of the strategy, right? How do you use the strategy, right? The moving parts and components, right? The pros and the cons, and then we go into trade examples and actual trade applications. Okay. Now, so selling call spreads. Okay. Now, so what is effectively a call spread over here that we're talking about? Now, what we're really doing in today's session is really just adding on a position, right, from what we covered yesterday, right? Because what we did yesterday was we covered the idea and the topic of selling a call option, right? So call option came with many aspects of the trade, right, that we do not like, right? Things like merger and acquisition risk, things like ex-dividend risk, right, and things like exponential move, right, causing bigger than expected losses on the trade that we wanted to do. Right now, so if you turn around, all right, and sell a call option, okay, all right, now, so you sell a call option, what you get to do is to collect money that goes into your pockets, okay, but using that money over here, what you should do is to pack up an insurance policy on that trade. Now, that is where you actually go and turn around, okay, spend a little bit of that money, all right, and go and buy what we call a higher strike call option, right? So you sell a call option, right? Decide what strikes you're going to pick from there, and then you turn around, use a little bit of the cash that you've collected, right, and pay for a higher strike call option than the one you have sold. Okay, now you do this because the higher strike call option will cost less. Okay, it will cost less than what you have collected over here, right? Which then means, okay, after doing both sides of the story, right, you still get to collect what we call the offsetted amount. Yeah, okay, because this side is going to be more expensive, okay, and you are paying for something that costs less, right? So there's going to be this offset remainder amount of the premiums that you'll be able to keep inside of your pockets over here. Right now, I hope that's clear. Okay, let's move on. Now, next part over here, just following on from yesterday's example. Right now, if we did the Royal Caribbean call spreads, that means if we decided to go about selling a call spread on RCL, okay, if we did this for the 22nd of May, all right, yesterday we discussed the idea of selling the 46 call option. Okay, now, so if you sell the 46 call option over here, right, yesterday we discussed that you could pocket around 40 cents, right, for doing so, right? So you could pocket about 40 cents for doing so. Okay, now, but it comes with what we call the unlimited risk, right? Where if the stock keeps going higher, which it actually did, right, you would have actually compounded losses on this trade. Okay, now, if instead you turn around, right, you turn around and right after that, you spend a little bit of that money that you've collected, right, and you use it to buy a 47 call option, right? So this is where we said a higher strike over here, right? So if you turn around and buy the 47 call option, right, this 47 call option will cost you somewhere, right, perhaps around 27 cents, right, maybe somewhere around the ballpark of 27 cents. Okay, so that's going to leave you with the offsetted amount over here, right? And if you calculate it right, the offsetted amount, right, equates to a 13 cents credit. Okay, a 13 cents credit into your pockets after doing both components inside the call spread. Okay, now, so you're still going to be able to pocket something from the trade. It's significantly lesser, right, than what you did yesterday. Okay, yesterday we collected 40 cents. Today it's just 13 cents. Okay, but in return, all right, what are you going to get? We'll discuss that in a while. Okay, now, so we also said this yesterday, the break-even price. Okay, it's going to be the strike price. Okay, in this event, it has to be the sell strike price. Okay, plus the premiums that you're collecting. So in this case today, 13 cents. Okay, 13 cents. Okay, now, so this is how the trade structure is going to look like, okay, in a diagram format. Okay, now, so the stock is sitting at 43.87, right, 43.87, right? So by selling the 46 call, right, we got 40 cents for it. Okay, and then we use some of those cash over here, right, take out 27 cents, right, to pay for the 47 call that we're actually buying, right? So this leaves us with the 13 cents credit over here. Okay, now, so what happens is now our break-even price is sitting at 46.13, all right, 46.13, okay, which means then that anything below 46.13, right, it's going to bring us what we call profitability. Okay, profitability. Now, it also means anywhere from where the stock price is today, all right, and up until, all right, our break-even price over here, right, this is where we have our margin for error. Okay, our margin for error. Now, which means if the stock goes up, all right, we can still end up winning on this trade, all right, and it can keep going up all the way to 46.13, all right, before we'll end up with a break-even scenario. Yeah, okay, break-even scenario. Okay, anything less than that would still mean that the options are going to expire worthless. Yeah, okay, now imagine this. If Royal Caribbean goes up, right, but it goes up to 45.50, all right, 45.50, all right, your customer, who is the buyer of the call option, right, he has the right to buy RCL, all right, Royal Caribbean shares at $46. But if the stock market is selling it for 45.50, right, it doesn't make sense for him to exercise his right over here. He might as well just go to the stock market, pay 45.50, all right, and buy those stocks outright. Yeah, okay, now this is why the call options will actually end up expiring worthless, right? Okay, I hope you got that over here. Yeah, so both options are going to expire worthless, right? So we won't have any issues over here, all right, by doing this trade. Okay, now, so this is what we call the conservative approach, right, where you pack yourself with a huge margin for error, okay, in case the stock goes up and you're wrong, either with your market direction or you're wrong with your market timing. Yeah, okay. Now, so anything above 46.13, right, it's going to equate to a loss on that trade net, right? Now, but in exchange, what we get for the lower offsetted amount that we are pocketing today, right, is this element of what we call a max loss. Okay, so right now, what you're doing is you're selling, a very insured call option spread, okay, whereby, hey, you're going to pocket 13 cents up front, right, and your max loss on the entire trade is actually only going to be $1. Right, if you work it out quickly over here, right, it also means that if you make it right, okay, and you win on this trade, right, a 13 cents premium will equate to almost a 13% return, right, on your risk to reward ratio, right, and that's pretty good over here. Yeah, all right, now we say pretty good because for a trade like that, okay, yesterday we talked about the deposit requirements, right? The deposit requirements that the broker wants if you're going to go ahead and sell call options. That works up to about 20% of the sell call strike. Okay, but when you're going about and selling a call spread, okay, the broker changes their stance. Okay, because you realize that in this case, the option strategy packs a maximum loss limit. Right? And in this case of our example, the maximum loss limit is actually $1. Right? So the broker takes a stance whereby if you can put up what you will lose, I would actually let you go ahead and do this. Okay, so the deposits or the investment required to do this trade that we're talking about right now is actually the $1 max loss that we are looking at. Yeah, okay. All right, now, so let's go on to the other way of doing so. All right, so before I do this, all right, let me seek some comments and interaction from those of you who are joining us right now. Okay, if you're joining us right now, okay, what's the more aggressive way of selling a call spread over here? So yesterday we talked about the more aggressive way. Okay, all right now. So if you're trying to be more aggressive, all right, what will you do, all right, in terms of selling a call spread? Okay, which means, okay, what kind of strike will you be looking to sell over here? So we have Royal Caribbean trading at 43.87. Okay, so what kind of a call strike do you think you'll be picking if you're trying to be more aggressive over here? Right? Okay, leave it in the comments. I'd like to see if some of you or all of you will be able to pick this up. Yeah. Okay, leave it in the comments. What call strikes, okay, will you be selling if you're going to be more aggressive on this trade over here? All right, great, Ploy. All right, so you say at the money. All right, could you put a dollar figure to it? All right, which means what's the strike that you're going to pick over here? All right, so side says 44. All right, side says 44 over here. All right, Anthony says 45. All right, how about the others who are joining us for today's session over here? Yeah, all right. Now I see more people are joining us right now. So if you have not done so, could you just click on the share buttons? Yeah, okay, so we could get this video out to people who are following your thread, okay, and get them to join us on this live discussion and live sessions as well, if they're investing or looking at investing, yeah? Right now, so Belinda says 44, right? Shini says 43, right? We'll sell the 43 and buy the 44, right? That's interesting, right? Okay, David says 45, okay, depending on the premiums. Okay, so Irene says 44. So let's take a look. Ruben says 43, all right? So let's go take a look over here. Now, so if you're gonna decide to be a little bit more aggressive, okay, what you can do is like what Ploy said earlier. Okay, you could decide to sell what we call an at-the-money call option, right? So if you sell an at-the-money call option, right, 44 will probably be the most at-the-money over here that we can look at. Now, so you can look to pocket around 105 or 106, all right, around that mark over here, right? And then you could turn around and buy the 45 strike, okay, which costs about 60. You could turn around and sell the 45 strike, sorry, okay, which buy, sorry. I haven't had my dinner. Okay, right now we'll buy the 45 strike and perhaps somewhere around 68 cents. Okay, right. So let's round the figures up and make it a little bit easier, right? So let's put this at 108. Okay, let me cross both of these out. Okay, and let me put this at selling it for 108 over here, right? And then paying to buy this at about 68. Okay, right now, so that's where we got our 40 cents over here in our calculations. Okay, so you realize one thing over here, right? By selling this 44 strike, okay, what's going to happen? Okay, what's going to happen is you're going to have the sell strike line sitting much closer to where the stock price currently is. So ultimately, you're going to get paid a much higher amount, okay, for this call option. Okay, you're going to turn around and spend that money, okay, and buy the 45 strike call, which is actually the next higher strike call option actually. Okay, now and for that action that you just done, okay, you're actually going to pocket 40 cents credit for that. Okay, now so if we add 40 cents credit to the strike, to the call strike that we're selling, okay, we're actually going to make 44. The break in for error. Okay, it's only going to be much smaller than before. Okay, much smaller than before. Right. So as you can realize, okay, let me just pull up both of them. Okay, so you realize over here, our break even is all the way up to 46. Okay, versus the one we're doing right now. Okay, where we are break even is only 44.40. Right, so you realize we have much lesser margins for error over here. That means if the stock starts going up, right, we don't have that much of a comfort zone, right, to allow it to go up too much by. Yeah, okay. Now, so the break even over here is 44.40. Okay, now, but the same thing that we have over here is this. If it starts to go up higher than 44.40, okay, what we have is still the similar scenario, right, where we actually pack on a $1 max loss. Okay, a $1 max loss. Okay, now, so this is the reason why it's a much better option to sell than the naked call options that we discussed yesterday. Okay, right, so selling call options comes with a lot of risk that is beyond your control. All right, so doing it via a call spread trade, right, would allow you to achieve much more comfort, right, knowing exactly how much you would lose even before you got started. Right, so let's say if I'm willing to risk only $1 or $100 on each contract that I'm selling, okay, I'm going to go around and look to structure a $1, right, strike difference between the two call options. If I'm willing to accept $2 in max loss or $200 for one contract, then I'll be looking at a strike difference of somewhere around $2 between the strikes. Okay, now just take a look over here. If we did a $2 max loss, that means we'll probably do the 44 and 46 over here. So we'll probably be looking at 108, right, and paying somewhere around 32 cents. All right, somewhere around 40 cents. Okay, somewhere in the middle over here, right? Somewhere around 40 cents for the 46 call option. Okay, 46 call option. Okay, now that would mean that a $2 max loss would allow you to collect a 60 cents credit up front. Okay, round about a 60 cents credit up front. Okay, or 68 cents credit. Okay, to be exact. Okay, right. So that's how you actually move the strikes around, tweak it around according to your risk profile over here. How much risk are you willing to take on the trade? Okay, and how much of the returns do you want to collect, okay, out of the trade structure itself? Okay. All right. Now, so is this clear for everyone who's joining us so far? Is everyone following? right? If you're following so far, could you just type follow in the comment section? All right. Okay. If you're following so far, could you just type follow on the comment section? All right, great. So Gary is following us, Ploy is following us. Okay, great. Okay, so many of you have been asking me about selling call options and call spreads, right? So this is really a deep dive into why we do this, right? And what are some of the approaches that you can take over here. Yeah. All right. Now, so anything higher is going to bring all the way to the max loss of $1 over here. Okay. Now, so how do we use this strategy? Right, the approach is pretty much similar from yesterday, right? Because it's just a variation from selling call options outright. Okay, so you have to be bearish on the start, be it whether you're short-term or long-term bearish. Okay, next, breakout patterns, which means you are trading this based on technical indicators. Okay, bear flags, okay, descending triangles, your head and shoulders break on the bottom side. Okay, either your many indicators which are perhaps pointing you on a downtrend, or an overbought indicator coming back down. Okay, all right. Anything that signals that the stock has lost steam and is probably looking to come off over here. Yeah, okay, that's what you're looking at now. So you can look to sell call spreads, right, when you're bearish. Okay, so that's the main idea. Okay, but you also want to limit the risk of a loss over here. Right, so the biggest takeaway over here is the fact that you could do this, right? You could sell a call option and participate by profiting on the downside, okay? And you want to do this with a limited risk of loss, okay? Limited risk of loss, okay? All right, now, so the pros and the cons over here, the moving parts, okay? So it's all down to what's your expectation of the move, right? Which means you think it's going down, okay, but just in case it goes up, all right, is there a resistance somewhere? Is there a blockage somewhere? Is there an obstruction somewhere? Okay, now that's probably where you want to position your call strike that you're selling, or something higher than that. Okay, now, so how long do you think this would take? Okay, 1 week, 2 weeks, 3 weeks. This is going to determine what expiry you're going to sell this call option for, right? And how much do you want to allocate into this trade? So if you're doing a $100 per contract max risk, okay, how many contracts do you want to trade? If you're doing it via a $200 max loss, how many contracts do you want to trade? Okay, so these are what we call the moving parts, all right, where you have to decide upon. Okay, now, so the last part we'll go through over here before we go to live examples. Okay, is the pros and the cons. Okay, so same thing, you do not need to be correct. Okay, you always have that margin for error. Okay, you have the benefit of time decay. So option sellers are effectively what we call selling time. Right, we are time sellers over here right now. So you are trying to benefit from the time decay. Okay, next, there's a margin for error, which means you don't have to be correct in order to win on this trade. Yeah. Now, there's also today, with this strategy, a limited loss concept. Okay, I can decide how much I want to lose from the very beginning of the trade itself. Okay, now next we get the leverage. Okay, realize if I'm making a $1 max loss trade right now, okay, I only need to put up $1 as a form of a deposit to get this trade done. Yeah, okay, so I could make anywhere from 40 cents on the $1 risk, all right, that I'm looking at taking over here, right? So this presents a much higher ROI on the trade itself. Yeah, okay, on the trade itself. Now, so the risk over here still stays at merger and acquisition, right? Exponential moves and breakout moves over here, right? But we are today now protected by this pro over here, which is called limited loss. Yeah, okay. So I hope you see, while we pocket much less, all right, selling and adopting a call spread strategy, right, being an insured call seller, all right, while you pocket much less upfront, okay, you are also taking on much lesser risk upfront. Okay, so this is definitely a good hedge, right? Looking at all the exponential risks that can come with selling call options. Okay, all right. Now, so who's ready to see some live examples right now? Okay, if you're ready to see some live examples, can you do me a favor? Type live examples in your comment section. All right, live examples. Okay, live examples. Okay, if you want to see some live examples right now, okay, type live examples in the comment section, okay, while I get ready my broker's platform. great. Give me a minute while I set it up. Okay, today I'm going to actually present to you some thoughts and process of probably some contrarian trades that you could look at taking in the markets right now. Yeah, okay, definitely contrarian. Yeah, right now I say contrarian because the market is in a bullish mode right now. So anything that you consider taking a short perspective, all right, is definitely a contrarian view right now. Yeah, okay. All right, so we're ready to go. Okay, great. Now, so I'm just going to use the first example over here on the Russell 2000 ETF or the IWM, right? So let's say on the 9th of June, right? On the 9th of June, one day prior to the federal meeting that we had yesterday, all right, which concluded with a power statement. Okay, so let's say you were bearish. Okay, that means you expect, the whole bullishness is priced in. Okay, you probably expect a downside move over here after the announcement is made. Okay, now, so let's take a look. So if you're thinking of going short on the IWM, you could do one thing, either go short on the stock. Okay, 2, sell a naked call, which we discussed yesterday, can be very risky, right? And 3, today we are on the topic of selling call spreads. Okay, now, so if you wish to do that over here, right, you could take a very short-term expiry, which is Friday. Okay, you can look at Friday over here, right? And then, right, you could look at a call strike, something like that. Okay, the IWM is trading at 150, as you can see it over here, 150. Okay, now, so if you think it's going down, but you're not very sure about it, all right, you're not very sure about it, what you could do over here is you could go all the way to 155. Okay, 155. Okay, let's take a look at IWM on the charts. Okay, now, so the high was over here at around 153. Okay, all right, and then we had the last gap bottom, which started at around 154.68. So 155, all right, would be a decent, all right, a decent call strike to be selling over here, right? If you really think about going short. Now, so if you sell the 155, okay, let's see how much you could get. All right, the broker says on that day you could get somewhere around 80 cents, which is down the middle, right? Okay, and if you turn around, and buy the 156, okay, that means you're not very sure, you want to keep the risk small. Okay, you buy the 156, right, which puts the max loss at $1, right? It'll still allow you to collect somewhere around 22 cents, right? You realize by offsetting these two amounts over here, right, which are different color coded, right? You're collecting 80 cents from selling it, right? And then paying 58 cents to buy, right? You're still gonna be making 22 cents, okay, for selling this call spread, right? So 22 cents on a deposit of $1, okay, which is the max loss. Okay, so come Friday, okay, if nothing happens and IWM doesn't pop above 155, both of these call options are gonna expire, which means they become worthless, right? So the 22 cents that you took in your pockets are now entirely yours, free from obligations. Okay, now this is typically how option sellers, right, would make their profits, which means they sell a product, in this case the call spreads upfront. Okay, they pocket 22 cents, okay, and they get to keep every single cent of it, right, once these options expire without any claims or liabilities on them. Yeah, okay, all right, now, so you can do that trade over here, all right, and take 22 cents, okay, and wait for Friday's expiry, right? Now, but something that many people do not know when it comes to options trading, yeah, okay, is the fact of the word I just said, trading. Yeah, okay, you could trade options. Okay, so it doesn't mean that when I sell this on the 9th of June, okay, I have to hold it all the way to expiry. No, right? Essentially, when I'm selling options, it is no different, right? It's no different from going short on the stock. Okay, so if I sold a pair of options, the call spreads, at 22 cents today, okay, I could effectively buy back the entire combo, right? Because when I sell a combo, if I spend some money to buy back the entire combo, that means I'm canceling out my trades inside of my account. Okay, and when I cancel out my trades, it leaves my accounts with no trades at all of what I've just done. Okay, but of course, right, I need to see if any profits will be made from the difference in the amount, right, in both transactions over here, right now. So just an example, right, if we did this on the 9th of June, okay, we pocketed 22 cents doing so. Okay, now, yesterday the markets fell off, right? I think IWM fell off to 146, right? So it's pretty drastic. It fell off by almost $4 over here. Now, so let's look at our strikes, okay, and let's see what they're worth today. Okay, what they're worth today. Okay, so we did the 150, it's tomorrow's expiry, 12th of June, right? So we did the 155, 156, right? Now, so you could see very quickly the 155, right? It's probably only going to cost anywhere from 14 to 17 cents. Okay, now, so let's have a look over here. The day before, all right, what I did with the 155 was I sold it, all right? I sold it. Now, so to close any trades from a mathematical standpoint, okay, if you want nothing in your account, right, that means the quantities should be zero. Okay, the quantities should be zero, right? Now, if what you have in your account, right, is a position that says -1, right? So to make it zero is simply to add one of it back. Okay, now, so if you add one of it back, that means you're going to the stock market to buy that item, okay, to buy that item. So for the 155 call, right, what I'm going to do is I have to buy it, right, if I want to cancel it out inside of my account, okay, right? Now, that also means for the 156, right, 156, which I have effectively over here, all right, bought it, okay, on the 9th of June, okay, so my account shows me +1. So if I want to make it zero, that simply means I have to sell it off, okay, all right? So I need to take the position of selling the 156 call option. Now, so if I do that over here, right, the broker suggests, all right, that I could pay, all right, I could pay about 6 cents to get this done, all right? I could pay 6 cents to get it closed out in tonight's trading session. Yeah, okay, of course, you know, if the markets open negatively today, right, IWM is probably going to open even lower, right? That means the options that I have, right, is going to be probably priced even lower, right? Now, but the effective term is this. If I sold it a day earlier for 22 cents, right, if today I want to get rid of it, I have to pay 6 cents as indicated by the market, right? So what's going to be my profit then, right? My profit is basically going to be the difference between these two amounts over here. Right now, so if I close it off today, right, I would have to pay 6 cents, which simply means I would stand to make 6 cents lesser, right, than if I wait all the way to expiry. Yeah, okay, now, but it'll still bring me a profit of somewhere around minus 6 cents, that means 16 cents, right? So I still stand to make somewhere around 16 cents over here, right, for just one day, right, effectively, all right, or just 2 days, okay, of the trade itself. Right, so 2 days into the trade, right, and you could stand to make 16 cents, okay, out of a risk of $1 over here. So that's almost 16% return, right, in 2 days over here, right, with limited loss situations, right, that you're looking at. Okay, now, so this is how you would sell a call spread over here, right, and you know what you really want to be looking, yeah, okay, what you really want to be looking at over here. Okay, all right, now, so is this clear? All right, would you like to see another example? Right, that means similar examples over here, but how you could use a call spread to generate a much higher profitability. All right, okay, now if you want to see that over here, right, type I want. Yeah, all right, I want it. Yeah, okay, leave a comment over there and say you want it, I want it. Okay, I want to see it. Yeah, okay, if you want to see what I just said over here, type I want to see it. Okay, while I wait for some of you to leave the comments over here, I'll just answer Josephine's question. Okay, so closing above 5 cents. I was assume Josephine meant 5 cents over here. There's no commission. Right now, as a perk on TD Ameritrade in Singapore, right? If you're trading options over here, especially as a seller, right, for the option that you're buying back, right, specifically the 155 call, right? So that's our selling position. Right, by buying it back, okay, if the premiums right? If the premiums that you're paying to buy back an option, right, it's less than 5 cents, okay, in the market, right, the brokers will waive off the commission fee, right? But as you realize, the 155 call, right, is still costing somewhere around 15 cents, right? So unfortunately, this closing over here will still incur commissions. Yeah, all right, still going to incur commissions. Okay, all right, Josephine? Okay, all right. Zen, no worries, we're going to get there, all right? Okay, potential examples, all right? I talked about the contrarian view, yeah, all right? Okay, leave it. Let's get through the examples. Let's understand how this is done first. All right, great to see Zest over here. Yeah, okay, all right, now. Let me close off. Okay, all right, now. So with the same example, the exact same trade over here, how could I increase my profitability? Okay, now, so the way to increase your profitability, all right, is really doing this instead. Now, so on the 9th of June, with the Russell trading at 150.26, all right, what we said earlier is you could look at selling an at-the-money combo, at-the-money call spread. Now, so if you believe that it's going to go lower, all right, now you could sell the 151 call spread, okay? Now, so that's going to bring you, okay, the 151 call, okay, it's going to bring you somewhere around 231, okay, and if you turn around and buy the 152, all right, it's going to bring you about 185, all right? So let's round this off, right, to make calculations easier, right? So that means 86, 96, 06, 16, 26, 46 cents. All right, okay, now, so if you do this instead, which is an at-the-money call spread, okay, and you sell it over here, all right, you stand to make 46 cents, all right, by selling it. Okay, so you realize for the other trade earlier, right, we only managed to take 22 cents, which ain't that bad, okay? Now, but for this particular trade, okay, we are actually able to pocket 46 cents up front on the same risk of $1, right, on the same risk of $1, okay? All right, now, so let's go ahead and see what kind of profitability are we able to make, all right? Now, so same thing today, all right? We did the one, let me just confirm this, we did the 151, 152, all right? So if I'm gonna buy back the 151, all right, I've got to pay around 68 cents for it, all right? And I'm gonna turn around and sell off the 152, all right? So doing the opposing action over here. Right, so the broker suggests, right, that I'll probably have to pay around 19 cents to close off the combo today. All right, so that means I'll still be able to make a profit of 46 cents, less 19 cents. Right, so that give me a profit of 27 cents over here. Right, so this is going to bring me a 27-cent profit. Okay, a 27-cent profit. Yeah, okay. Right now, so you realize the profitability is a little bit higher over here. 16 cents versus 27 cents. Okay, so a 16% return, right, versus a 27% return. Okay, now I'm not going too in details over here, right, because of course, if you want to get really technical, right, the margins that is required is not effectively one, right, it's $1 less the premiums that you've collected, right, but just for simple calculations, let's do it as one. Yeah, okay, right, if we do it as so, right, we are also being more conservative. Right, so you realize in Impossible Investors, most of our returns that we portray out there are actually on a more conservative calculation basis. Yeah, okay. Now, if we take on what the broker really wants from us, okay, we would be rocketing sky high in terms of the returns we're making. Yeah, okay. Now, so in this trade over here, the second example is 27 cent. Okay, 27%. Okay, now who wants to be able to make even higher? All right, okay, now, since, you guys are joining me in today's session over here, so for, those of you who have spent the effort and time to dedicate your 1 hour to me, all right, I want to bring maximum value over here, right? Who wants to see an example, another trade example, all right, on the same stock, same scenario, right, that can bring you even higher profitability, right? Okay, if you want that, right, now leave a comment, higher profits, okay? If you want to see higher profits from, similar trades over here, right, do so, type higher profits in the comments. Okay, higher profits. Okay, and if I get more than, okay, let's do this. If I get more than 10 of the comments, higher profits. If I get more than 10 of it, all right, I promise you, I'll show you right now. Okay, that means if I see less than 10, all right, I'm going to move on to today's trade over here. Okay, all right. Okay, so let's see. 1, 2, 3, 4, 5, 6. All right, so we're getting there. 1, 2, 3, 4, 5, 6, 7, 8. All right, more. 9. Okay, 10. 11. Damn, I should have asked for 20. All right, okay, now, so let me do this. Okay, let me share with all of you over here. Now, I'm not sure how many of you actually thought of it, all right, but the other way you could do it is, if you're really sure, right, you're really sure that it's going to drop, okay, that means you're really sure that it's going to fall off, right, what you could do is you could start in the money. Yeah, okay, you could start in the money, right? Now, so what do I mean when I say you start in the money, right? So the stock, the IWM is sitting at 150.26, right? You could actually start off by selling at 149, all right? Now, I say this because you were adamant, all right, that it's going to go down, right? So which means you expect it to go down, all right? And let's say you're familiar with IWM movements, right? That means if it really has a down day, all right, it's more than capable of falling like $3 to $4 in a single day. Right now, so that will mean that going below 149 after the Fed announcement is actually very possible, all right, very possible. Now, so if you start off by selling the 149, right, you get somewhere around 345, okay, let's say 345. Now, if you turn around, right, and keep it at a $1 risk, okay, it's the same $1 risk, okay, but you buy the, so you buy the 150, yeah, okay, you buy the 150. Okay, now, so what you're going to do over here is you're going to pay about $285 for that. Okay, now, so can you realize by starting off over here, right, you are already making, right, 60 cents into your pockets, right, 60 cents into your pockets. Yeah, okay, all right, now, let's swap it out a little bit, okay, let's move the strikes a little bit more, right, so let's say I decided to sell the 148, okay, so I'm going to start off with 148, and I'm going to buy the 149, okay, all right, now, so it means I can pocket somewhere around, all right, 65 cents. Yeah, all right, 65 cents, all right, for this trade over here. All right, it's the same call spreads with the same $1 max loss. Okay, but out of the $1 max loss, I'm choosing to collect 65 cents upfront, which effectively means if I'm wrong on this trade, all I'm risking now is 35 cents. Or $35 on one contract. Yeah, okay, right now. So let's see what the trade brings about today. Okay, all right. So we all know it went down. Okay, but what's the difference in the scenario now? So at 148, I'll have to buy it back. Okay, all right. And in exchange, I have to turn around, okay, and sell the 149. Okay, so if I close that off today, okay, the broker says that I have to pay about 38 cents to close it off. Okay, 38 cents to close it off. Now, so this means 65 cents to 38 cents. Okay, now that would bring me a profitability 25, 26, 27. All right, okay, 27 cents as of today. Yeah, okay. Now, so right now, it's not going to achieve better profitability than the one that I did at the money. Okay, but you realize that if I were to get another down move today, right, which also brings it closer to expiry, right, these premiums that we're seeing right now could go much lower to perhaps 30 cents or 25 cents. Okay, and when that happens, my profitability is actually going to be richer because I collected much more upfront. Yeah, okay, and on expiry, needless to say, right, if I'm right, okay, I stand to make 65 cents, right, on the risk of 35 cents. Okay, right now, so let's analyze what we did over here. The first scenario, right, we pack on the most and the biggest margin for safety, okay, margin for error, okay, but we only started off by collecting 27 cents. Okay, now, so if you collect 27 cents upfront, I think it was 27 cents, right? Now, so if I collect 27 cents upfront, it means that I'm risking, all right, I'm risking 73 cents to make this 27 cents. Okay, but I can be wrong. Okay, I have a room for error. Okay, now if I start off at the money, right, so I'm collecting 45 cents, right, by risking 55 cents. Okay, right, and the last scenario, by collecting 65 cents upfront, right, I'm risking 35 cents to make this 65 cents. But all of them have different risk elements over here in terms of how much you need the stock to go down by before you can make these profits. Yeah. Okay. Now, so can you see how the structure is actually very, very interesting, right? So options is pretty much, anyone who are gamers in this room right now. I'm definitely not. Okay. Right. But anyone who are gamers over here, right? These are very similar scenarios to your RPG games where it requires thought process and strategy, right? So one simple strategy like that, but there are various ways to adopt them depending on what your outlook is and what your expected outcome is. Okay, that's why those are the movable parts that we mentioned earlier. Okay, all right. Now, is this good so far? Okay, now if it's good so far, right, type good. All right, okay, good so far, type good. Okay, if you're not done so, click on the like buttons as well. All right, okay, like buttons as well. Okay, and then I'm going to go into today's contrarian trade idea. Okay, I'm going to go into today's contrarian trade idea. Right, thank you, YC. Right, okay, while we wait for more of you to come in over here on your comments, all right, let me just quickly address Ploy's question. Right now, Ploy is asking, all right, Terence, what if I sell 2 calls, right, and then I turn around and buy 1 call option? Now, you realize, right, this is simply what we call a lopsided move, all right? Okay, I don't want to go into the specific strategy name for it right now, but what you're doing over here is ratio call selling, right now, and you have 2 sell positions, but you only have 1 buy call. Right now, which ultimately means that one of the call option that you're selling is still naked. Right. So while you're looking to pocket more upfront, right, but you lack 1 protection for the call option you're selling. Right. So if it surges up, right, you're still gonna have the same problem as we discussed yesterday, right? Because you have 1 additional naked call over here. Yeah. Okay. Right now. So I hope that answers your question. Okay, now, same thing as well. If you have any variations, thoughts, and questions in your head regarding selling a call spread, okay, leave them in the comments over here, all right, so I can help you clarify them and give you a better understanding of the strategies that are being discussed on each day of the challenge, okay, all right? Okay, now, so let's get to today's contrarian trade idea. Okay, now, and one of the trade ideas that I'm looking at, okay, that's pretty interesting over here, right, is the concept of surges on travel industry, right? Travel industry, and of course, bankruptcy stocks over here. That means companies that declared bankruptcy. Okay, now, so definitely what you're seeing over here is companies like Boeing, right, where we had that surge on, earlier this week, right, only to see come off on Tuesday and Wednesday. Okay, and those are pretty sharp turnarounds over here as well. Okay, now, so if we have what we call a blow-off move, all right, and then a corrective move after that, all right, now, so what you can consider over here, all right, it's actually taking a risk, right, to expect or bet on the stock going further down. Okay, now, so in this scenario over here, I may actually be tempted, right, to try to take what we call a very controlled risk kind of outlook. Right now, when I say this, I simply mean, for example, we could see Boeing stock going from like 195, right, to as high as 230 in a single day, right? And yesterday we witnessed Boeing shares, right, going from 211, right, to as low as 197, right? So it could easily go up or down by $10 in a day, right? $10 in a day, right? Now, so having said that over here, it doesn't harm, right? It doesn't harm for me to look to structure, right, the last case scenario that we put up earlier just now, right? Now, so if we look at Boeing over here, okay, okay, I could actually look at structuring a trade that could perhaps go out to a month from now. Okay, a month from now. So I'm going to give it a month for it to, fall off from where it currently is. Okay, right now, and okay, I probably don't like this in terms of the bid ask over here, all right, and also the option volumes that are being traded. Okay, so I'll probably stretch it, okay, all the way to the next month's expiry, okay, which is 17th of July, okay, because the monthly expiry options usually bring about better volume. Okay, as you can see, much more contracts are being traded over here. Right now, So having said that, if I expect it to fall by about $10 from here, okay, $10 from here, okay, what I could do is this. Okay, I could now say, right, perhaps, let's see what's the difference I'll be looking at. Okay, I could perhaps sell the 185 call, okay, right, which is, in the money right now, okay, 185 call, okay, and turning around and buy, right, the 190 call, right, okay, 185 call, right, and turning around and buy a 190 call. Right now, and what it tells me over here is this, okay, I would pocket about $2.87 up front. Okay, I'll pocket about $2.87 up front, okay, by selling this call spread. Okay, now what we're seeing over here are based on yesterday's closing prices. Okay, which means if I executed this sell call spread trade yesterday night, okay, before 4 a.m. close in Singapore time, okay, that means we are GMT plus 8, okay, 4 a.m. our time is when the US market closes. Okay, so if I dished off this trade, okay, at 3:55 a.m., right, this would probably be the premiums I can get for selling this combo. Okay, now, so if I get this for 287 over here, right, you realize, right, that the aftermarket hours saw Boeing trade all the way down to 191. Okay, 191. Okay, so today when the stock market opens, right, I'll probably be able, right, to start locking in profits on this trade immediately. Yeah, okay, all right, I'll probably start to profit from this trade immediately. Yeah, okay, all right, now, but at the same time, okay, by pocketing 287 up front, all I'm risking over here, right, it's actually 213, okay, 213, right? So I'm risking $2.13, right, to be able to make $2.87, right? If Boeing were to reverse, right, its move, right, that it recently just did over here. Yeah, okay, that's all I'm expecting for me to profit from this trade. I'm not expecting it to go all the way back down to here, no, right? But I'm just short-term bearish on this stock. Okay, just looking to profit from that correction move over here. Of course, I can be wrong. Okay, of course I can be wrong, which means Boeing today may turn around, right, and surge up higher and break a new high, right? But effectively, all I'm risking is $2.13 for one contract, okay, or equivalent to $213. Yeah, okay, so I'm looking to risk $213, right, for a $287 profitability, right, on this call spread trade over here. All right, okay, now for those of you who are more conservative, right, you could probably try to aim to sell a 231, all right, or 232 call spread, okay, right, which is probably where the current high is. Okay, so if you expect it not to break the high over the next 36 days, okay, so what you do is this, 237, so let's take a look. Okay, so you probably will be able to sell the 235, okay, sell the 235 and buy the 240, the same $5 loss over here, right? Now, so the difference is you're only going to pocket $1, right, $1 over here, $1.07, right, compared to the 287, right, that we were looking at earlier. Okay, right now, so $1.07, right, is what you're looking at. Now, so this means you're risking about $4. Okay, let me just round this up to make it easier for you to see. Right, you're risking about $3.90, okay, to make the $1.10 over here. Right, because as a seller, right, remember you're a company. Right, so when you're a company, right, you're selling this product that is in front of you right now. Okay, that means what you get for it, which is the 110 right now, okay, is the maximum profit that you're capable of making. Yeah, okay, right. But in exchange, right, the maximum loss you're facing over here is $5, right? Less of the 110 that you've just pocketed brings you the 390 that we spoke about earlier. Okay, now, so different scenarios. Do you want more protection, right, and lower profitability, all right, or, all right, higher profitability, but you better be right. Okay, so what are you looking at over here? So different scenarios to play this, right, and it brings about different execution of the strategies. Yeah, okay, right now, so this is just definitely one of the places you could look at over here, right? Likewise, okay, if you want to repeat similar scenarios, you could also do it on American Airlines. Okay, all right, American Airlines, because you see similar moves over here, forming a high, all right, and then we have the last 2 days where you see it turning down. All All right, RCL did exactly the same thing. All right, forming a high. All right, and then showing very aggressive signs of the tapering off. Yeah. Okay. All right. Now, as well, you can see all the bankruptcy companies we said earlier. All right, we have Hertz. All right, Hertz doing exactly the same thing. All right, so you see it sprung to a new high. All right, on Monday. All right, and then we see Tuesday. Right, an inside day over here, and then Wednesday breaking below that. Yeah. Okay. All right. Now, so all these are what we call strong reversal moves over here. So if you think it's going to continue, right, then selling a call spread, all right, is an idea to do so with limited risk, right? Limited risk. Okay. All right. Now, so how many of you want to learn something more today? Right? How many of you want to learn something more today? Right? If you want to learn something more today, all right, type more. Okay, type more in the comments. Okay, my time is actually up. Yeah, all right. I meant to go for my dinner before my next session later on. Right, but it's okay. All right, I want to add value over here. All right, so if you want more, all right, okay, you want more, okay, do me this. All right, click on the like buttons over here and type more in the comments. Get more in the comments. Yeah, okay. All right, so this time I'm going to ask for 20. I did it. Yes, 20. All right, so if I get 20 of you telling me more on the screen right now, okay, I'll do it. Okay, I'll do it. Okay, if I get 20 of you telling me more on the screen, I'll do it. Okay. All right. So let me get counting. Oh no, I'm gonna lose that. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 17. All right, 17. All right, so no, 17. All right. You need more. You need more, guys. 18. 2 more. All right, 2 more. Let's go. Let's go. Floyd. All right, I'm going to count you as 19, okay? I'm going to count you as 19. All right, okay. All right, so we're past 20. We're past 20. Okay, all right, now. So, this is going back to the question the other day. Okay, going back to the question the other day. Because selling call spreads, okay, selling call spreads are similar directions moves, right, to buying a put spread. Yeah, okay. So I'm going to compare now selling a call spread versus buying a put spread, and which would seem like a better proposition over here. Okay, which would seem like a better proposition. Okay, all right, now. So this is definitely going to teach you in terms of, when you have a certain idea over here, does it make more sense in the market today, right, to actually use call strategies, or does it make more sense to use put strategies? Yeah, okay, right now. So this is definitely something good for you to learn, right, if you don't know it yet. Okay, so let's use a similar trade where we discussed just now. Okay, now, which means if I sell the 185, okay, and then I buy the 190 call, right, this call spread goes for 287. Right, so you can see over here, the call spread goes for 287. Okay, I'm just going to leave it in the comments so most of you will be able to see it. Okay. Okay, now, so a similar put spread trade, right, is just going to be the opposite over here. All right, which means I'm going to buy the 190, right, and then I'm going to sell, right, the 185. Okay, now, and I've got to pay 210 for it. Okay, I've got to pay 210 for it. Okay, all right, now $2.10 for it. Okay, and this is a debit. Okay, all right, now, so you realize, okay, now, having seen, I've just put it out in the comments over here. Okay, so I'll flash it over here so all of you can see it. So if you sell the call spread, it's going to bring you 287 credit. Okay, but if you choose to buy a similar put spread, okay, with the same success rate over here, probabilities, okay, you got to pay 210 upfront. Okay, 210 upfront. Okay, now, so let me ask you this question. If your expectations, okay, if your expectations is for Boeing shares, okay, to start going below 185, okay, that means you expect it to go even lower than 185. Okay, even lower than 185. Okay, Right now, so the question is, what? Okay, all right. The question is, what do you think is the better trade? Okay, leave it in the comments. I would love to see your comments over here. Okay, now, so which one do you think is a better trade? Okay, would you say selling the call spread is a better trade, or would you say buying the put spread is actually a better trade? Yeah, okay. Which one is better? Okay, for this particular Boeing trade over here, which one is better? Buying the put spread or selling the call spread? All right, so we have mixes over here. We have some saying buying the puts, we have some saying selling the calls. And this is the exact reason why I want to do this as an extra component right now, okay? Right now. So this is the learning point for most of you, okay? Ready? Ready to learn? All right, once I'm done, we can wrap today's session up, okay? Right now. So you realize the difference is really this, okay? If you buy the put options, okay, that means if you buy the put spreads, okay, you are paying 210 to buy it now. Okay, now that means you're risking 210, all right, to be able to make a maximum profit of 290. All right, let me say this again. If you buy the put spreads, okay, you're risking 210 to make a maximum profit of 290. Okay, now, so I just said it over here. Right now, so for those of you who have answered earlier, okay, do you think you need to change your answer now? Okay, so which do you think is better? If you buy the put spread, you're risking 210 because that's what you're paying, all right? But your profitability on the trade is 290. Okay, but if you sell the call spread, okay, you are collecting 287, all right? So that's your max profit over here, okay? But you're risking 213. Okay, you're risking 213. Yeah, okay, all right. Now, so which is better then? It's almost similar, all right? It's almost similar, all right? But right now, okay, the buy put spread ages out a little bit, all right? It ages out a little bit because there's a 3-cent difference over there, all right? There's a 3-cent difference over there. Okay, now you realize the call spread over here, right? Risk 213, right? If you're wrong, okay, where else, right? Right now, by buying the put spread, you only pay 210, right? You only pay 210. Yeah, okay, so it's pretty much looking at the risk perspective, 210 versus 213. Okay, so not much of a difference, but the put option side still ages out a little bit. Okay, so sometimes when you're looking at a particular trade, you have a view over here, right? It doesn't harm to compare either side, right, and see if we have what we call an option skew. Right? Okay, because at a certain point of time, you have an option skew over here, right? Where, put options are priced much more expensive, right? So sometimes by buying the put spreads, okay, it's actually much cheaper over here, right? To buy the put spreads versus selling the call spreads over here. Yeah, okay, all right, now. So this is one way to tell which is actually a better trade, okay? Because both of them are similar setups. Okay, both of them are similar setups. That means if Boeing were to go below 185, you're going to achieve maximum profits. Okay, so they're the same setup. Okay, now, but which one risks less over here, right? In the event you're wrong. Okay, all right, now, so I hope you understand that. So the answer over here, right? The answer over here is actually buy put spreads. Okay, so the correct answer, which is the better one over here, is the buy put spread. Marginally, all right, marginally, but it is still the buy put spreads. Okay, all right, now, so I hope you managed to understand that over here. Okay, so let's open up to some questions. Okay, Richard, you're very fixated on the deltas, okay, because I realize you're asking me this every time. We do not determine the trades that we will take, or we do not determine the strikes that we will take, right, by the deltas, especially when you're an option seller, right? You don't determine it by the deltas. Okay, all right. You need to determine it by external factors like are there anything that's protecting me before the strike I'm selecting, right? Are there, resistance points? Are there, moving average obstacles, stuff like that. Yeah, okay. Now, so those are more particular, right, when it comes to selection over here, right? Welcome, Manina. All right, glad you understand it clearly. So don't bank too much on deltas over here, right? Deltas is just a little bit of an add-on over here. In terms of, I know some trainers over here actually tell you to select trades over here based on deltas of the option, right? If you are a buyer, right? If you're a buyer, it makes a lot more sense to buy bigger deltas, right? But when you're a seller, right, you really want to plan on what is a better strike and what kind of ROIs you want to generate from it. Okay, so like I said earlier, if you really feel strongly that it's going to go below, right, that means Boeing shares are going to trade lower, right? As you can see, pre-markets right now has gotten below 188. Okay, right now, so if you really believe it's going to drop off, okay, then you would choose an in-the-money call spread. Okay, in-the-money call spread. But if you're not very sure, you're not very confident, right, then it'll make a lot of sense to put your sell call strike, right, above the previous high. Yeah, right, above the previous high. So, if it turns around and breaks the high, you could actually still close off the trade before it expires. Yeah, okay. All right, I hope I answered that question over here. Let's get to Ploy's question. Can we apply this to choose between buy calls or sell puts when we are bullish? Yes, you can as well, right? Yes, you can as well, but you have to start seeing the point where this will only make sense, right? This will only make sense when you're doing it kind of at the money or in the money. Okay, you're doing it at the money or in the money. Once you start going into what we call out of the money, all right? So when selling options out of the money presents that margin for error, okay, all right, margin for error. So that's a different ballgame altogether. Yeah, okay, so you realize the comparison that I did over here, right, was only for the in the money one that we did. I didn't compare the one, right, where I was doing the 250, if I'm not wrong. BA. I didn't compare the one where I was doing above 230. Yeah, okay, 230. Okay, because that would be a totally different scenario altogether, right? Because right, it would be too expensive to buy the 235 puts, all right, and then turning around to sell the all right, okay, so it doesn't make sense in that way anymore. Okay, only if you want to do it at the money. Okay, Ploy? Stop loss. Okay, all right, now, so Richard, a stop loss over here would be pretty much simple, all right, which means, for example, if today, okay, today I have this trade over here, all right, done, all right, for 287. Okay, so I executed, it got filled, all right, the trade is in my account. Okay, and then tomorrow, all right, which is later today, Boeing actually turns around and goes higher. All right, so if it goes around and turns higher, right, that means my call spread trade is wrong because I need it to go down. All right, so what I'm going to see over here is I'm going to see that the premiums, all right, from 287, I'm going to see the premiums get higher and higher. All right, okay, it's going to go higher and higher. Right now, so that's where you decide how much do you want to lose. For example, if you see the premiums hit 4, okay, that means for this call spread, once you see the premium hits $4, right, you can decide to place an order, close the call spread trade, and pay $4 for it. So that means your loss is going to be $4 minus 287 that you're getting for selling it right now. Okay, right, so that's your equivalent of a stop loss over here. Right, otherwise the max loss will be achieved, all right, when sorry, the air condition is on. All right, now, so otherwise, if you leave it all the way to expiry, then the max loss effect will kick in. All right, so you got two forms of, a loss protection over here. One, the maximum loss on expiry, okay, and two, if you close it earlier, then, you're looking at whatever is the difference between how much you pay to close it later on. Okay, Richard? Okay, all right, now, so thank you very much for those of you who are joining us in today's session over here. All right, so let me just change back quickly to my PowerPoint and show you our topics for tomorrow. Okay, so give me a minute over here. All right, so tomorrow is going to be day 12 of our challenge over here. All right, so as well as today, right? So tomorrow we're going to start the session at 6 p.m. in the evening, okay? Right, so tomorrow is another day where we're going at 6 p.m. in the evening, right? So do make note of the time, right? So tomorrow we're going to go into the topic of selling put options. Okay, so tomorrow we're going to the topic of selling put options. Okay, so join us, okay, if you want to find out more about selling put options and selling specifically naked put options, okay, all right, now, so tomorrow the time is going to be 6 p.m. in the evening as well, okay, so join us, Singapore time, GMT +8, 6 p.m. in the evening on Facebook Live, okay, or, you know, if you're on various channels, we are now also streaming on YouTube Live, all right, so you could join us there as well. Okay, do remember, help us to share the videos out if you have not done so as well. Okay, and so more people will be able to join us tomorrow. Okay, and if you have not done so, or if you have friends who are investing right now, okay, do get them to join our Telegram group as well. Okay, the QR code is at the bottom of the screen. Okay, and I'll see all of you at the same time, same channel tomorrow. Okay, all right, same time, same channel tomorrow. Okay, all right. Bye, everyone. See you tomorrow. I hope you enjoyed today's session. All right, welcome, Uncle Tan. Welcome, Ikai. All right, welcome, Irene. Okay, bye-bye, everyone.